What we've noticed is that the economy is behaving, somewhat differently than I think most people expected, just given the various policy pivots that the Trump administration has implemented. So obviously we've gotten really large tariff increases. We have immigration policy U-turns. We have various other things. And I think the surprising thing for many is that the manifestation of those policy changes in the economy would be through price level adjustments. And I think what we're seeing as we go through the year and we're gaining more information is that companies aren't necessarily increasing prices by as much as people expected. They are doing it on the margin, but they're also trying to reduce costs. And part of the way that they're reducing costs is they're just maintaining their labor costs, or they're even trying to actually reduce labor costs. So we've seen a pretty material deceleration in labor market activity this year. We think that part of the reason why they're choosing to do this is that you have clashing forces. You have this immigration U-turn. There's less labor supply, less people coming into the labor market. But you also have this technology boom that's happening in the background. And so they're trying to figure out how can we save money through implementation of technology. And we think that's also having an effect here. So I think that's why you're seeing more concern out of Federal Reserve officials more recently. We think it's why they took the first step to start lowering interest rates again in September. And ultimately, we think that will be a reason for them to cut a couple more times this year as that labor market stays weak. But 2026, I think, does look a lot better as you get some more of the one big beautiful bill stimulus that's hitting the economy to offset all of this.
Yeah, that's kind of where I wanted to go, Tiffany. Tiffany, about 2026 and the tax cuts, the credits, those things that were in fact included in that tax bill. Are you putting that into your model in 2026 as a driver of this economy?
Yeah, I mean, so if you look at, the tax cuts were retroactive, which means that, both businesses and households will get a one-time larger check. You're seeing that in the business tax data already that the Treasury publishes, but you're also going to see it when households file for refunds early next year. The refund checks are going to be large, especially those households that work jobs where they work overtime. Any taxes paid in 2025 on overtime is basically going to be rebated back to them at the beginning of 2026. So that's going to be a pretty large refund check in addition to the enhanced child tax credits, et cetera. Yeah. So we think that will help. It's a one-time thing for sure, in terms of the retroactiveness of it, but it will help to sort of bridge the economy through this period of weakness, we think, as you have the tariffs that are also starting to bite.
Ken, our global technical director, wants to know if he can, the rebate he's going to get for overtime.
Yep.
I mean, is that incoming?
Boom.
Boom. I think it's going to be brilliant. Tiffany Wilding with us with Pimco. Tiffany, I just brought up Atlanta GDP now, 3.842%. I did a regression back to the end of 2022, the Yardeni Encampora low. And the answer is we're plus a solid 1.2 standard deviations. We've been there. This is the third time. I mean, is that a one-off kind of boom? Do you think it just pulls back? Or do we just completely misjudge the sustained real GDP, as Torsten Slok of Apollo mentioned earlier this week?
Yeah, well, I think we got really good news with the recent revisions to second quarter GDP, which also included, what the BEA calls annual benchmark revisions. And they new data that's more complete that is included in that. And one of the big things that was revised higher was the savings rate over the last several years. So it just suggests that, consumers have a bigger buffer here. We've been talking about this sort of K-shaped economy now for a couple of years, where you have, higher end consumers that have, higher wealth as a result of increasing housing prices and equity markets since the pandemic, et cetera. And so you have consumers that have a bigger buffer coming into this period. And that argues for them just to be more resilient. We think that the resilience in the consumer that you're seeing is related to that. Ultimately, we think you still will see some slowdown in the fourth quarter. But yeah, the consumer looks better.